Welcome back to the Daily Crypto Deep Dive. Right now, one of the most important things happening in crypto isn't a headline, a tweet, or a breaking story. It's the shape of the market itself. Bitcoin has been compressing into an increasingly tight range, and that compression is telling us far more about what comes next than any single news event. When price action narrows like this, it means tension is building, liquidity is stacking, and the market is approaching a point where indecision becomes unsustainable. Something has to give. What we're seeing is Bitcoin coiling into what traders describe as a triangle structure. That simply means price is making higher lows while simultaneously making lower highs. Buyers are stepping in sooner each time, sellers are defending earlier each time, and the range is shrinking. This kind of structure doesn't tell us direction by itself, but it tells us timing. As price moves closer to the apex of the triangle, the probability of a decisive move increases sharply, and markets don't stay compressed forever. When analysts talk about Bitcoin forming a triangle, they're not talking about anything abstract or mysterious. In simple terms, it means the price is being squeezed between two converging trend lines. Each time Bitcoin pulls back, buyers are stepping in a little earlier, creating higher lows. At the same time, each rally is being sold a little sooner, creating lower highs. As those two lines move closer together, the range tightens. That tightening tells us indecision is building, liquidity is stacking, and the market is approaching a point where it can no longer drift sideways. Historically, when price gets this compressed, it doesn't stay quiet for long. It forces a decision. This matters because the context around this pattern is very different from previous cycles. Bitcoin is no longer trading in isolation. It is now deeply connected to macro liquidity, ETF flows, derivatives positioning, and broader risk sentiment. So when this triangle resolves, the impact won't be limited to Bitcoin alone. It will ripple through Ethereum, altcoins, crypto equities, and even traditional markets that now carry indirect Bitcoin exposure. To understand what happens next, it helps to think in conditional terms rather than predictions. Not Bitcoin will do this, but if this happens, then this tends to happen next. That's how professionals frame uncertainty. Let's start with the upside scenario. If Bitcoin breaks cleanly above the upper boundary of this triangle and closes convincingly above the key resistance zone around $93,000, the first thing that tends to happen is a shift in psychology. Analysts like Damian Nowashevsky have pointed out that this level isn't just technical, it's behavioral. A close above that area signals that sellers who have been defending the range are losing control. When that happens, sidelined capital that has been waiting for confirmation often starts to move. In that scenario, the next area the market tends to gravitate toward is the high $90,000 zone, with $99,000 acting as a magnet rather than a target. It's not that everyone suddenly believes Bitcoin is worth that price. It's that positioning and liquidity naturally pull price toward areas where there are clusters of orders, options interest, and psychological significance. This is why round numbers matter even when fundamentals haven't changed. If that upside break happens, the immediate spillover into the rest of the crypto market is usually uneven. Bitcoin typically moves first and fastest. Ethereum often lags the initial impulse, not because it's weaker, but because capital tends to concentrate into the most liquid asset during moments of confirmation. Ethereum usually starts to follow once traders feel confident the move is real, rather than a fake-out. In practical terms, an upside Bitcoin break often pushes Ethereum back toward key resistance levels, even if it doesn't break out immediately. Analysts watching Ethereum ETF flows note that a confirmed Bitcoin breakout can stabilize outflows or even reverse them, simply because risk appetite improves across the board. Ethereum doesn't need a perfect narrative in that moment. It just needs the market to stop fearing downside. Large-cap altcoins like Solana and XRP usually react in a second wave. They often underperform during the initial Bitcoin move and then catch up once dominance stabilizes. This is when you see rotation, rather than broad speculation. Traders move profits from Bitcoin into names with clearer narratives or stronger relative strength. Smaller altcoins and meme coins, if they move at all, usually move last and most violently. But only if liquidity fully flips risk on. Importantly, even in an upside scenario, Analysts caution that breakouts are rarely clean straight lines. Retests happen. Pullbacks happen. What matters is whether former resistance becomes support. If Bitcoin breaks above the triangle and then holds that level on a pullback, confidence builds. If it breaks and immediately falls back into the range, the move loses credibility quickly. Now let's look at the middle scenario, the one markets spend most of their time in. If Bitcoin fails to break above resistance and instead remains trapped inside the triangle, the market typically enters a grinding phase. This is where frustration sets in. Price moves enough to trigger emotions, but not enough to reward conviction. Analysts often describe this as a dominance-building phase. Bitcoin doesn't necessarily crash, but it absorbs attention and capital, while altcoins quietly bleed relative value. In this scenario, the key support area many analysts watch sits around $84,000. This level isn't magical, but it represents a zone where buyers have repeatedly stepped in. As long as that area holds, the market remains structurally intact, even if sentiment feels poor. This is the phase where headlines feel increasingly negative, not because things are getting worse, but because nothing is getting better. During these grind phases, Ethereum often struggles the most psychologically. It doesn't collapse, but it doesn't excite. ETF outflows can continue simply because investors are bored rather than bearish. Developers keep building. Fundamentals remain steady. Price just doesn't reflect it. This disconnect is uncomfortable, and it's why many people capitulate near the end of these phases rather than the beginning. Altcoins in this environment tend to suffer from neglect rather than panic. Liquidity dries up. Rallies fade quickly. Even good news struggles to move price. Analysts often describe this as a filtering period. Not every project survives it, and not every narrative returns. This is why experienced participants emphasize selectivity over diversification during indecisive markets. Now let's address the downside scenario, because ignoring it doesn't make it go away. If Bitcoin breaks down through the lower boundary of the triangle and confirms below support, the move tends to be faster and more emotionally charged than an upside break. That's because downside moves are often fueled by leverage. When support breaks, stop losses trigger, liquidations accelerate, and price can overshoot to the downside before stabilizing. In that case, the $84,000 region becomes critical. It's not just a technical level, it's a psychological checkpoint. If buyers step in there and defend it, the market can reset relatively quickly. If it fails, the narrative changes. Fear increases, volatility spikes, and the spillover into altcoins becomes more severe. Ethereum, in a downside Bitcoin break, typically drops more in percentage terms. That's not a judgment on Ethereum's fundamentals, it's simply beta. Higher beta assets move more when volatility increases. Altcoins follow suit, often with exaggerated moves. This is when people confuse price action with existential risk, even though the underlying causes are usually mechanical rather than fundamental. What's important to understand is that breakdowns don't necessarily invalidate long-term bullish theses. Analysts like Jeff Kendrick at Standard Chartered have been clear about this distinction. He has adjusted short-term expectations while maintaining longer-term targets that extend well beyond current prices. That's not contradiction, it's time horizon. Short-term structure and long-term adoption can coexist without aligning perfectly. When this structure resolves, whether up or down, it will feel obvious in hindsight. People will say the signs were clear. But in real time, clarity is rare. What matters is understanding the pathways rather than predicting the outcome. If Bitcoin breaks up, expect rotation, lagging catch-up moves, and renewed narrative energy. If it grinds sideways, expect boredom, frustration, and quiet redistribution. If it breaks down, expect volatility, fear, and then eventually opportunity. None of these outcomes define the end of the market. They define phases. And that's the deeper lesson of this setup. Markets don't move in straight lines. They move through tension, release, and retention. The triangle we're watching right now isn't a verdict, it's a process. For anyone watching this unfold, the question isn't what will Bitcoin do tomorrow? It's how do I behave while it decides? Because behavior in uncertainty is what determines long-term outcomes, not accuracy in prediction. This is a moment for context, not conviction. For awareness, not panic. For patience, not paralysis. This is also why these moments often feel emotionally draining. You're exposed to negative headlines, conflicting analyst views, and price action that refuses to reward patience immediately. That doesn't mean patience is wrong. It means patience is being tested. And this is where we leave it. Not with certainty, not with predictions, and not with promises, but with understanding. Markets like this don't reward speed or emotion. They reward patience, discipline, and perspective. This phase feels uncomfortable because it's supposed to. It strips away noise, tests conviction, and forces clarity about why you're here in the first place. Whether the next move is higher, lower, or sideways, what matters is that you stay engaged without being reactive, informed without being overwhelmed, and confident without being careless. Volatility will pass, narratives will change, and clarity will return. It always does. The people who benefit most are the ones who stay steady while others search for certainty. Stay sharp, stay patient, and stay in the game. And, as always, we will see you at the top.